So, hello everyone. Today it was a Sunday, and I woke up to a call from a friend of mine, and I got very excited at the fact that maybe it will be something related to an outing that is being planned because otherwise the day gets boring and all. So, I was expecting him to tell me that will you be able to join us, and I was very excited. And I picked up the call, and to my surprise, he did not ask about any outing or something, but he asked me about an IPO that is commencing from tomorrow. That is Monday, 7th of October. And he wanted my views on whether the investment in that particular IPO should be done or not. So I always appreciate the fact that people approach professionals for competent and trustworthy advice, especially if they are your friends, your relatives, or your peers who know that you know something very well, and it's always, very overwhelming. And I always recommend that not just, I mean, uh, you should always approach a professional whenever you need advice and you know that you would not be able to do something the way they would be able to do. So I think that is always appreciated. But he said something that that triggered me a lot, and which I get almost from 95% of the people I meet who are looking to invest in an IPO. He said that the gray market premium, which is all abbreviated as GMP of the particular IPO, is 18 or 20 rupees, and it looks good. Fundamentals he does not want to get into. He just wants to invest from a short term perspective, which is fine. I'll come to in what ways can you invest in an IPO, what how investors think and all. I'll come to that later. But this particular part, since I get it a lot from a lot of people, and today also when he said this triggered me, and I thought I would definitely have to create awareness about this GMP thing that is revolving in the minds of all retail investors who do not know the markets very well. So this video is all about that, how you should analyze an IPO properly before you actually invest, be it from the perspective of short term, be it from the perspective of a long term. I would try to bring my expertise and my professional journey, investment journey of 7 years into the picture and try to help you out. Obviously, I am also still learning, but I think this can still, uh, I mean, help a lot of you who actually just rely on the GMP thing and invest in search of a little gain. Maybe 4 5,000 is on an average. Maybe if a good IPO is there, you can make money just on the basis of GMP. So just because of that particular thing, you may land up to a wrong decision, which we have historically seen as well. So I want to create awareness through this video. So without further ado, let's begin. So as I was mentioning, there are two particular ways of how you actually invest in an IPO from the perspective of an investor. So either there is long term or there is short term. So let me, the one that I was mentioning, which I can correlate with the example of my friend that I gave you, is the example of short term investing, where you actually emphasize on the GMP, which is the gray market premium. Now, what is the gray market premium? You would have heard this terminology a lot, or maybe you would also have invested into it following the crowding effect, when a friend of yours or somebody would have told you that ये IPO का gray market premium per share 50 रुपया है, 20 शेयर है, 1000 रुपया बैठे बैठे मिलेगा. So you would also have, but you do not know what GMP is. So first of all, let me explain you how the concept of GMP works. GMP, basically, people who would have studied economics would understand, just works on the principle of demand and supply. So if for example, an IPO is very popular among the investors, let's say for example, an IPO for Zomato. So people know Zomato is doing very well. I'm talking about the fact when Zomato was about to launch. So people would know Zomato is going to do very well, because Zomato is a very good company, and people have actually, this Zomato has actually revolutionized the whole food ordering journey and all of that. So people were subscribing to the IPO that this company is going to give us good returns. Let's just keep on doing it. So if there are 1,000 shares that the company is offering for people to invest in, and there's a demand of 1 lakh shares, so there is the demand supply ratio is not matching. So when the demand ratio increases than the supply ratio, so then the GMP automatically increases. So then you would feel that GMP is more. So that is why, that is certain of, certainly we can fetch so much amount of return, which historically in my 7 years of investing journey, I have seen 80% of the cases it is true. But there are cases, if you are unlucky, you can lose your money as well. So I just want people to be aware of it, so that those 20% of the scenarios can also be avoided. There can be super normal situations. I'm not talking about that, but at least you can be cautious just how you do insurance. So short-term invest also, if a company is actually a good company which has a good board of director group or a good promoter group, the GMP will be higher. So GMP is a mix of n number of factors which indicates that if the IPO when the IPO gets listed, whether you will make money out of it or you will not. But the demand and supply parameter is above all, and it has a higher weightage in the GMP determination. So what this is how investors invest in an IPO on a short-term basis, where they just look at the GMP, they see what is the gray market premium ratio per share, they multiply it with the number of shares that they will apply in one lot of the IPO, they see how much money they are going to make, and then they apply for the IPO. And they actually want to liquidate all the amount on the day of listing itself, because nobody wants to have the hassle of tracking the stock again and again on a long term basis, even if you would fetch higher amount of return in the long term, but people just want to liquidate their holding on the day of listing itself and make money and enjoy the proceeds. So this is called short term IPO investing, and this is not a standard classification. This is what I have classified it as for ease of understanding. And another one is long term, people who actually invest into a company thinking from the perspective of long term, that if I invest in this company at a very small price right now when the company is offering me shares, and after 20 years, 25 years, maybe I'll get bonus shares out of it. There will be stock splits, and my number of shares will multiply, whatever it is, and the company will also grow, the business is going to grow. Then over the long term, I'm going to make money out of this. So this is a good opportunity. It is a good investment opportunity. So let me put in my money right now. Even if there is a loss on the listing date, I don't care, but I will look at the long term perspective. So these are the two types of investing that people look into, long term and short term. So this is something very important, that even if you are a short term investor, you should not just be triggered by the GMP. You should analyze additional factors, which I am going to talk about subsequently. Now, what is the first thing that you need to look at before we come to this slide? What you need to do is that you need to visit the SEBI website. So I have it open. So you just need to go to the SEBI website. Here you can go to filings, and then here you can go to public issues, and then here you can go to red herring documents filed with ROC. So when my friend actually called me, I visited this website, and I just wanted to have a look at this RHP, which stands for Red Herring Prospectus. What is that? I'm coming to it. So I already have this downloaded. This is a document which looks something like this. It is a 407-pager document, and it is a standard form. I mean, the format is very standard, which SEBI, as the regulator of the capital markets of our country, has proposed, that the proposed, this prospectus, in which a company that is trying to raise funds from the public to maintain complete transparency has to report so and so information to the investors, so that they know that they are putting in their money into a company, so they know each and everything that they need to know about the company. So this is an initiative from SEBI, and this is the example of the Garuda Construction and Engineering Limited, whose IPO is supposed to launch tomorrow. And I would try to list down the very few. I mean, it is not possible to go and dig into each and every point in this 407-pager document only through via this video. It is possible to do it practically, but in this 10 or 15-minute video, it is not possible to do. But still, I will try my best to keep it as simple as possible, so that even a layman can understand. So this is how a red herring prospectus looks like. And red herring prospectus is, I hope the meaning is clear. It is a preliminary offer document which is shared to the public through the stock exchange website or the SEBI website, so that there is complete transparency. Now, if we come up to the certain points that we need to look at while analyzing an IPO, of course, GMP is there. You would time of AC want to look at the GMP and understand if this is going to do well or not. But these are the factors that you need to dig into while you actually are putting your money. So the first point is fresh issue versus OFS. So what is fresh issue? Fresh issue means that the company is raising the funds for the first time. And for example, let's say there is a company that is a private limited company. It has never raised funds from the public, but for the first time, it is now trying to raise funds from public. So this is called a fresh issue. And also there is a concept called OFS, which is called offer for sale. So in this, the promoters or the directors or the pre-existing shareholders of a company. It can also be, venture capitalists or private equity firms who are actually holding shares of the company in the when they were actually, formed. Startups. We come across stories like startups where they are initially private, and then promoters and the venture capitalists, when the company grows, they exit, and then maybe a company can go public. So offer for sale is nothing but the pre-existing shareholders liquidate their stake in the company to actually give the shares to people who are actually looking to invest in it now. So now an IPO can be either a fresh issue, it can solely be an offer for sale, or it can be a combination of both fresh issue and offer for sale. So it can be the case that in case of Garuda, let me just come here. I'll show you the first page. If you can look at the portion highlighted, it says the type is fresh issue and an offer for sale. So it is both a fresh issue and an offer for sale. That means that the company is also raising funds from the public for the first time, and also certain promoters or directors or whosoever who actually hold shares of the company are actually liquidating their stake and exiting. So here you will see the size of the fresh issue. It is almost 1.83 crore shares that is fresh issue, and almost 95 lakh shares are offer for sale. That means 95 lakh shares which were already held by somebody, they are being sold off. So that if you add up, you'll get a total of 2.78 crores proposed shares that are, that will be a part of this IPO and people will subscribe to it. So let's say, for example, if there are 1 lakh shares in one lot, total there will be 278 people who can actually take lots. So that is how it is. Usually the lot size is not too higher, not as high as this, but I just, just to make the example numerically more easy. So this is something that you need to look at. And also there is disclosure about who is this promoter or pre-existing shareholder who is actually selling off 95 lakh shares. Is a company called PKH Ventures, and it is a promoter selling shareholder. So it is a company that is selling 95 lakh shares in Garuda to public. So this is also part of IPO, because IPO people, IPO public will only subscribe to these 95 lakh shares, right? So this is an information that needs to look upon. Now, what needs to be analyzed when you actually look at this information? A very high offer for sale ratio is a negative signal. Of course, there are IPOs where there will be a combination of both. There, the fresh issue size should always be higher than an offer for sale. I'm talking about prima facie. I will not talk about the fact that it is always a red flag, but I will also mostly, if you see, if the offer for sale and fresh issue is also at par. For example, if 100 shares are there for fresh issue, offer for sale also 100, so the ratio is 1:1, that is a red flag. The fresh issue size should always be higher, because that gives a signal that the company is trying or thinking something big, and that is why they are trying to raise funds. But an offer for sale would mean, it will give you a red signal. Why? Because why would people of a company or the promoters or the shareholders of a company want to exit that company if it is already doing well or if it is going to do well? It is a red flag, right? They would actually want to stick into the company. That is a different case, that they have some other investment opportunity and they want to, the opportunity cost is very high, so they are liquidating here and they're investing there. That you can dig into the prospectus or, research over it and understand. That is what you need to do. But mostly the ratio should not be very abrupt. In our case, if you see, it is almost a ratio of 2:1. 95 into 2 would be 190. This is 183. Around 1.8, 1.9 is to 1, something like that. So this is still, I would say, even though the fresh issue size is higher, but I would still say that it is a ratio which prima facie would look like a red signal to me. And I would want to dig into why PKH Ventures. I would research about PKH Ventures and see why this promoter 95 lakh shares they are liquidated. If the company is going to do well, what is the requirement to do so? So I hope this first point is very clear. Next, objectives behind raising funds. So, what is the objective for Garuda to raise these funds? What are they going to do with this funds? In normal cases when we have to give our money somewhere, so we would ask the end use of that money. Na? A friend would ask, or a relative would ask, or anybody would ask कि मेरे को 100 रुपए देना. I would definitely ask, हाँ ले ले, but क्या चाहिए? क्यों क्यों तेरे को चाहिए? I mean, obviously keeping the moral grounds and all aside, that why you are required to ask, but you would definitely want to know na, where your money has been put in. So you should always be aware of why the company is raising funds. खाली GMP देखने से नहीं होगा. ये तो समझो कि जीएमपी हो क्यों रहा है. Correct. So how do we see it from the prospectus over here? If you look at the offer, or let me just go to the index again. Objects of the offer. So it says our fresh issue. Our company proposes to utilize the funds which are being raised towards funding the following objects and achieve the benefits of so and so. Working capital requirements, general corporate expenses, and unidentified inorganic acquisitions. So, what is working capital requirement? वर्किंग कैपिटल रिक्वायरमेंट मींस बिजनेस करने के लिए जो पैसा चाहिए ना, वो चाहिए. नॉर्मली बिजनेस करने के लिए कुछ सामान लेना है, कुछ सप्लाई करवाना है, या वॉट एवर यू वॉन्ट. Working capital is that this means if a company is trying to raise funds for working capital requirements, it means that the business objective is good, but they don't have the funds to actually do business. So that is why they, to grow, they need funds from the public so that they can maintain their cash generation. So this we can verify from the cash flow statement, which I will come later, to actually see if the company is burning its cash or not. So we will be able to do a consistency check. Next, coming to general corporate expenses. To run a company is a very big hassle. You have to pay sitting fees to the directors, KMP fees, independent director, and so many things you have to pay. And normal administrative costs, rent ho gaya, or whatever. So all these general corporate expenses, because they are burning cash, so they don't have funds. So they need to maintain all this also, na. So because you need to have a proper working environment also to actually do business. You have to do staff welfare expenses, whatever. So we are not digging into all of that right now. But if you look at the prospectus, you'll find what are these general corporate expenses. There's a detailed schedule given, and also unidentified inorganic acquisitions. So this company is also, first of all, what does this company do? Sorry, I forgot to mention. This is an EPC company. What is an EPC company? EPC company is it stands for engineering, procurement, and construction companies, which actually do the whole design and engineering of a project. I mean, a construction project, infrastructure project. They onboard vendors, the laborers, and everything end to end. So this is what an EPC company does until the completion of the project. So Garuda is into that. So whenever there will be a boom for the infrastructure sector, or this engineering industry, Garuda will also flourish. So this is what does unidentified inorganic acquisition mean? So it may be the case when Garuda is doing business and it has funds, that it will see that a company has certain features which, if the Garuda will acquire, it will help them in doing their business. So why do people acquire companies? To benefit from synergy. Synergy is when A plus B is not equal to AB but greater than AB. So if A plus B is 10, then when you merge together, you generate 12. So this extra 2 is called synergy. So company will this funds, they can acquire companies and they can help their business grow with people, additional professionals joining them in, and whatsoever. So is the objective clear? This objective will make you think कि क्या मेरे को इस चीज में पैसा डालना चाहिए. क्या ये कंपनी इसका पैसा नहीं है, क्या ये एक्वायर कर पाएगा, हाउ मेनी प्लेयर्स आर देयर इन द इंजीनियरिंग इंडस्ट्री, सो मेरा फंड्स वेस्ट तो नहीं हो जाएगा. So all these things can you can actually think about it. Working capital requirement is one you will find in almost all the companies who are trying to raise funds, because people do require funds for working capital, and in the initial years they do burn cash. So I think this is a very common thing, but still you need to dig in. So this was the second point, objectives behind raising funds. Now we'll come into the debt position, whether how leverage kitna hai company mein, matlab how much borrowings it has, and what will happen if it will not be able to repay. So then there is a whole process called IBC, insolvency and bankruptcy, where the company is actually supposed to file for bankruptcy, and then the company will cease operations and your money will uh, you will end up losing your money. So we need to properly check if it is paying finance costs, whether it is being able to cover the finance cost, which you will check through the interest coverage ratio, and you will also check the debt equity ratio. So we need to check that बहुत ज़्यादा leverage तो नहीं है ना company. So how do we check that? We again come to prospectus is your mother document. You will find everything, each and everything. You don't need to go to Google. You don't need to go to anything, and it has been designed very well by SEBI. So hats off to SEBI for that. So you come to this portion called financial indebtedness. So here you will see, I'm not going to the language so much because this is something the homework has been done by me. I have to just try to, summarize it in this video. So the company has just taken a vehicle loan of 22.50 lakhs, which is 22 lakhs. But we need to see what is the equity of the company. If the equity of the company is only 10 lakhs, then this is a very major red flag. 10 lakh equity है नेटवर्थ कंपनी का 10 लाख है और डेट ही 22 लाख का. So this is 2.2 times the debt equity ratio, which is very high. So this year, the whole information about this is given that, for which car it was Hyundai Alcazar, 60 EMIs of this much amount, this is going to continue till 2027. And then here, the name of the lender is Union Bank of India. First charge on stock and book debt. So if the company fails to repay, then stock options would have to be provided to the lender and so on. So this is all the cash credit limit and the bank guarantee, which can be other financing arrangements, which you have to dig into. But the main prima facie thing here is that there is a loan of 22 lakhs over here. Now we need to check if the equity ratio, I mean, the equity amount is, very significant so that they can cover up this debt amount. So we'll quickly jump into that. So we go to the summary of financial information, and we see that this also I have highlighted. And if we go to the equity amount, this is for year ended 31st March 24. This is in lakhs. So you will see the total equity to be 119 crores. And here the borrowing amount is 1 crore. No, this is 10 lakhs. I'm sorry. So this is 10 lakhs, and there that the amount was 22 point something, whatever. But why here it is 10? Because the company would have been making repayment also. Na? So as on date, only 10 lakhs is outstanding. And the equity is 119 crores. So you can imagine it is almost it is a very high number, and the company is not at a risk of leverage. I mean, risk of not being able to repay its debt. So this we have checked. So this is something that needs to be checked as well when you're actually investing into a company. This is the finance cost and everything. Finance cost is the interest cost that I'm paying. If you see the profit before tax, it is almost 50 crores, and the interest cost is only 2.47 lakhs. So 2 lakhs out of a profit of 50 crores. So again, you can easily, the interest coverage ratio is also very high, which is given by interest by EBIT. I mean, the EBITDA by interest. EBITDA is earning before interest, tax, depreciation, and amortization. You just add depreciation and finance cost to this profit, so you'll get the EBITDA divided by the interest cost. So this will be a very high number, and you can easily pay the interest. So this is a green flag for the company. So this also we checked. Now we need to check if there is any risk. So for that, what we need to do is that we'll go to the outstanding litigation and material development section. Here there are a list of pending litigations against the company, which individuals would have filed, or as a matter of fact, this people would have to read to understand if there is a risk that court can give some adverse order against the company, and this can be an unfavorable situation for the company. So this is something that needs to be really looked upon, and it is a big disclosure, so I'm not going into the intricacies. But if on reading of it you understand that the court is definitely going to impose, because you also have to apply your judgment, right? You also have to think that if the court is going to impose a very heavy fine, and which can be a threat to the going concern of the company, you would think 10 times before putting your money into such a company. So this is something that needs to be pondered upon. This is the major risk factor that needs to be checked. Next, we come to a section called BOD. I mean, who the board of directors comprises of, who are the promoters, so that we actually know who are the people who are running the company. I think that would be the general information section. Yeah, here is the list. We have Praveen Kumar, Mohit Kapoor, and so whatsoever, I mean, whoever it is. So you need to actually check if these people are competent to run the company. You go to the LinkedIn profile, you do research about them, whether they are able to run the company, and whether the growth prospects that you have in mind, with whether these people would be able to live up to those expectations, and then you think if it is right to put your money into this company or not. Next, there are other sections which I highlighted and which I would, I think financial information which I would like to show is, I think we discussed about debt. profitability of the company is good, you would see the profit has decreased from 23 to 24, but that is because they are, they have a cash crunch, they have incurred so many expenses, so that could be the reason. But there's a major jump from 2022 to 23. So all these things needs to be analyzed. We are not doing a very financial analysis right now. This is just a, a prima facie dive into how you should analyze things. Cash flow, you would see cash generated from operating activities from in 2023, this was 1833.75. In 24, it has reduced to 747. That means that there is the cash burning, and that is where the company is raising funds for working capital. It was 1680 in 2022, then it increased, then it decreased. So in this year, they have a major decrease. And in this particular year, month only, for April 30, they have a negative cash generated. So that means they do need funds. So this is a consistency check. So this was one of the things that we need to check. And finally, one of the very important things that needs to be checked is that, let me see if there's some other portion that I want to discuss. I think there are n number of sections, but these are the prima facie important sections, which I feel are relevant for this video perspective. But do let me know if you want me to discuss any of the other sections in detail in any of the upcoming videos. Yeah. So now coming to valuation, how you actually check if the company is overvalued or undervalued. So from the balance sheet, you would know if you go to the financial information section, if you go to the balance sheet, or if not balance sheet, maybe in the summary section. I've not checked that where it is disclosed, so I would not waste time into it. But in the prospectus, you will find how many shares are pre-existing and how many shares would be there after the issue IPO shares get listed. So technically, the shares that are already held by the promoters and the public will buy, so that will have no impact. But the fresh issue will definitely have an impact. So you need to check how many shares. Suppose there were 100 shares before the IPO. Now there's a fresh issue of 20 shares. So after the IPO, there will be a total of 120 shares. So this you need to note down somewhere. And then what you need to do is you need to see the profitability of the company, technically the PAT, which is the profit after tax ratio. This PAT you will divide by the number of shares. So you will get this PAT you will divide with the number of shares 120 post IPO. So you will get an earnings per share ratio. So for every one share, how much how much profit the company is earning. If I have an earnings per share ratio of 25, so that means that for every one share, the shareholder is earning a profit of 25 rupees. So now you will get the EPS, and then you need to calculate the PE ratio, which is called the price to earnings ratio. Price you will get from the price that you're paying for one share when you're applying for the IPO. Suppose, let's say, for example, it is 120 or 125. You're paying 125 per share when you're applying for the IPO, and this earnings EPS ratio that you calculated is denoted by E in the PE ratio. P is 125 divided by E. So you will get 125 by 25 because you calculated 25. So you get a P ratio of 5. Now what you do is you go to Google and you research about other EPC companies, how are they priced. If you see that those companies have a P ratio of 12, 14, 16, and your company that you're going to invest is having a P ratio of 5, that means it is a lower price company and it is underpriced, and it makes sense of investing into that company given all the other factors that we discussed in mind. And if it is a reverse case where you are 5 and the peer companies are priced at 3, P ratio of 2, 2.53, that means you're overpriced, and you need to be very sure that if I would pay, just like how we buy a phone, if we are paying more for something, whether it is giving me additional features, whether this company will give me additional returns, dividends in the future, out of all analysis that I've done. So this is the valuation exercise that you need to undertake before actually putting in your money. So I think these 6 points should be really kept in mind. And this red herring prospectus is your Bible, your Holy Quran, or your Bhagavad Gita when you're actually going to invest into a company. If you ask me that, do you actually analyze this 407 periods before you actually invest in a company? I would say yes. Maybe for you as a fresher, it would take you a lot of time. For me, it would take less time because I know where exactly I will find what. So, but when I also started it, it took me time. So as and when the learning curve theory comes into the picture, as and when you start doing things, you learn them, and then maybe it will take you lesser time. But this is a very highly recommended thing. And maybe that is why people want to take shortcuts and they don't want to do it themselves and they go to financial consultants, or just like my friend came to me, "Ye kare ki nahi kare." But that is fine. That is what our job is. But mainly relying on GMP thing is incorrect, which I really want to emphasize right now. Why, I will tell you. I will also give you examples of companies. Let me just recall where companies there it showed a GMP, but they actually listed at a discount. Because if you would have put a 120 rupees into the company, you only the stock actually listed at 90 or 100. Let me recall the name of the company. It was maybe, I recall IRM Energy was there. Then there was a Muthoot company. I don't recall maybe exactly the name. It was, I think, Muthoot Small Finance or Microfinance, something like that. And also there was another company called Suraj Estate Development, something like that. So I think these three companies I can recall right now who actually showed GMP, and people if would have invested based on GMP, I'm sorry, would have actually put in their money, but they made a loss out of it. Mainly, maybe it could be for the reason that maybe people would have analyzed the prospectus very well, or there was less demand in the later days. Generally, an IPO is there for 3 days. So you need to be very sure before investing and just not rely on the GMP thing. So this was the only message which I wanted to convey through this video. And I mean, there are n number of things that can be analyzed. There is no end to things, but I would urge all of you before investing, do look into these factors that we discussed. And if there are other factors which you feel can be relevant, which I would have maybe, through the for the constraint of time would have missed out discussing on this video, or you would want me to discuss later, please do let me know. I think it will be great for all of us to be enlightened and stay invested. And one more fact which I want to point out is that I think till the first 8 months of 2024, we have seen so many IPOs coming. Till August 2024, the total amount of money raised through IPO investment is almost USD 12.2 billion, which is almost 1 lakh crore in INR. So 1 lakh crore means 1 ke baad 12 zero, which is a very big figure. And people are actually, I'm sure out of this 1 lakh crore, almost 90,000 crore would have been through on the basis of GM, and maybe luck is in their side, so maybe they would have made money. And 80% of the success rate is, I admit the fact that 80% success rate is there based on GMP, but we need to always be insured against contingencies, and this is something we should always have something. I mean, stock markets are not something where you can have 100% certainty. This also I admit, but you can at least be mentally prepared, and you would never regret making a decision. You will avoid the regret aversion bias later if you actually make decision based on your own analysis. If somebody would just tell you GMP ke basis mein kar lo and you make a loss, then you would curse that person. But if you've already made a decision based on your analysis, then you would be contented. नहीं, मेरा ये mistake हुआ था देखने में, next time I will keep it in mind, and you learn from your mistakes. So this is the message which I wanted to convey to this video, and I hope it was helpful.